Good evening. This is Ken Long from Tortoise Capital Management. It's August 17th, 2009, and we've had signals firing in our overreaction system, and so I want to take you through that report, how to read the spreadsheet, and then demonstrate what it looks like as a pattern on the chart. So we're going to demonstrate the overreaction system. This is an extract down here of what the report looks like on the daily. And you can see all of the usual suspects have fired green except for EFA, the global index. So now we'll zoom in on SPY and take a little closer look. So we've got three rules. Rule number one is that the close must be greater than the 200-day moving average. So our close is at 98.31. And the 200-day moving average is 86.95. So yes, close is greater than the 200-day. Second rule is that the daily high must be less than the 10-day moving average. So today's high was 98.95, and the 10-day moving average was 100.44. So the daily high is less than the 10-day moving average, yes. Third rule is that the close must be less than the long trigger. So the close was 98.31, the long trigger was 98.89, so yes, the close is less than the long trigger. That fires, when all three fire yes, the symbol turns green, and we have a signal to buy tomorrow at the open. Now the long trigger represents a move of 1 ATR percentage below the 10-day moving average. So that's where the long trigger is calculated from. And you can see that in the rule set. Now let's take a look at that on a chart. And now what we have is SPY, and we have the most recent last 10 days. I'll just kind of zoom in on that. Makes it a little bit easier to see, so you can see the 10-day moving average. And you can see on the Williams percent R10, it's in oversold conditions. That's of interest to us in the channeling system. And what we have, as you can see, is this significant move away from the recent trend. The recent trend looks like that 10-day moving average, which is the blue line in the middle. And we've moved, you can see all price action from today is on the wrong side of the 10-day moving average, so it's south of that. And that move was significant enough, more than 1 ATR percentage, or 1.5% for SPY, that this now creates a tradable gap based on the high probability event that in the next 5 to 7 days, this price will move back to rejoin the 10-day moving average. So this gap right in here, created by the volatility event, is what gives us the tradable edge. Now we're going to place a stop 3% below our entry tomorrow at the open, and that's how we execute the mechanical system. And our signal to get out of this will be a return to normal, which is going to be defined as a return to close above the 10-day moving average. Now the edge is gone. That will be our signal to get out of this position. The reason we care about these oversold conditions, as you can see in previous iterations, some powerful things can happen when you get an extreme move away from that 10-day moving average. So that's a quick look at the ETF overreaction system. It turns out that if you look at any of the other symbols that fired, they would all have this general pattern represented. Because those large indexes are strongly correlated to SPY, you wouldn't be surprised by that. So thanks for your attention.